Business FM.
This is The Morning Drive. It's Mira at Business FM. My name is Tim Elliott. Welcome to an hour of personal finance and interesting news story that appeared last week in the papers. All too often, I kind of think, and it's almost an oxymoron, really. It's almost oxymoronically, which if that's not a word yet, it now should be. Interest is kind of seen as not really of interest, but I think it's really important to understand how interest works, how to make it work in your favour, probably reasonable to say, and to understand the difference between simple and compound interest and how it can work for you. Compound interest, by the way, and we'll outline the details of this in a moment, prohibited here in the UAE, but more on that to come. Independent financial consultant James Thomas is here. It's always a pleasure to see you.
Good morning. Pleasure to be here.
Good to have you here. I know you've read this report, James. The inspiration for today's topic comes from a Supreme Court ruling last week. I think it was last week. It was reported last week, at least. Here's the headline. UAE Supreme Court bans compound interest on bank loans. So obviously the ears go up, and I imagine you're like, oh, let me have a look at that. Let's first of all take a look at the news stories. So what happened is, the essence of it is this. UAE's top court, the Federal Supreme Court, has reaffirmed that financial institutions in the UAE are prohibited from charging interest on accumulated or compound interest. So the total interest payable, James, can't exceed the original value of the loans. That's really what they've said, isn't
absolutely.
it? We'll get into the story in a moment, but just you've seen the story, your immediate reaction to it.
My immediate reaction is it's very positive for borrowers, because without that, your loan could effectively run completely out of control.
Well, it is, and it's understanding that, isn't it? Because, I mean, how many of us go and, I don't know, take a car loan and you really want the car and you don't really look at the details of the... many of us don't. No, we shouldn't, but it's true,
You should do, but of course you see that lovely shiny new car that you've wanted, you've been lusting after. It may not be the car, it might be another item, but nonetheless, the principle is still the same. It's something you really want to have, but the car is the most obvious one, and therefore, when you're offered a loan to allow you to avail of that car, you jump on it, and you jump on the paperwork, you fill the forms in, you provide your documents they ask for as quickly as you possibly can, and then that bright, shiny new vehicle is sitting on your drive in your parking space.
Oh, that's such a good feeling as well. But you said there the principle remains the same, and the point of this is, if in simple interest terms, the principle does remain the same, I suppose.
Yes, indeed.
Little double entendre going on there.
Lots of double entendres, but...
which I kind of liked. But let's look at the story here and try and work this out, because what I've done is put together a couple of what I hope are fairly simple answers to give hopefully a decent idea of how simple interest works and how compound interest works. In some ways you think, there's not much there, but over time there can be a huge difference.
An enormous difference.
And that's really the point.
And obviously the more or the larger the principal, the sum that you borrow, the more obviously the interest will accumulate, and therefore you can find yourself in a position where, like this particular case, where the amount that was being requested was over twice the amount that was originally borrowed.
That's right, and that's the key. Let's get into it then. So the Supreme Court is the UAE's highest court. There's just overturned a judgment that had ordered a borrower to pay over 1.5 million dirhams, 1.553 to be exact, but over 1.5 million dirhams, huge amount of money, on a loan originally valued at 700,000 dirhams. Okay, they sent the case back to the Court of Appeal for reconsideration. So, the bank in question here had filed a lawsuit seeking 1.919 million dirhams, nearly 2 million dirhams, plus 11.25% annual interest, alleging that the borrower had defaulted on two facilities, one for 634,000 dirhams and another for 66,000 dirhams. The original principal of the loan, 700,000 dirhams. So cue lots of litigation, multiple rounds in fact. The court of first instance kind of the first appeal court, ordered the borrower to pay part of the claimed amount, interest capped at the value of the principal, 700,000 dirhams. Both parties appealed. The next court, the appellate court, then rules in favour of the bank. That repayment amount goes to 1.553 million dirhams. There's clearly, I don't need to make this clear, there's a huge amount of difference between that and the original, James. So that's where we are. The borrower then goes to the Supreme Court, arguing the total interest charge amounted to compound interest, prohibited under UAE law. The High Court, Supreme Court, agreed. They noted that the accrued interest of, as you pointed out just now, the exact figures over 860,000 dirhams exceeded the original loan amount of 700,000 dirhams. Hence the judgment. So the court clarifies that while banks may charge contractual or market rate interest on outstanding balances before account closure, only simple interest may be applied thereafter. Now we need to get into what simple interest is and compound interest is, I guess.
We do. And I appreciate this could open up a whole can of worms, but hopefully we can keep this in a format that's understandable to our listeners, because yes, sure. it is this, and this is again going back to our previous conversations, where you really need to understand what you're entering into. Yeah, it's all well and good wanting that shiny new car, but you need to understand what you're signing up for to enable you to have that. I'm using the car, whatever it might be, but the loan that you're taking out, you really need to understand how that interest is being calculated.
And in simple terms, I think a lot of us forget. I've certainly done this. I've had a couple of car loans in my time, and I have taken the loans, and I haven't really thought through that, in return for the bank saying, here's your loan, I have to pay a fee for that. And I never really think of it in those terms. And that fee is obviously the interest on the loan.
Yes.
Simple as that.
Simple as that. Now, there may be admin fees and other bits and pieces, but in essence, the cost or the in return for lending you that money, the bank will charge you. And that charge is the interest rate that they apply to that. And there's two ways that can be calculated, as we're mentioning: simple interest and compound interest. And again, to keep it as simple as possible, the simple interest is only applicable to the amount that you originally borrow, whereas compound interest is also on interest on interest on interest, if that makes sense.
I see where you're going.
When, again, linking back to previous conversations, when we are saving and building our wealth, that is the interest that we want to have. Yeah. Because obviously, it's effectively free growth, if we look at it that way, when it's in our favour. But when it's reverse, it's actually amplifying the amount that we owe. Whereas with simple interest, it's always on the original amount. To give some examples, let's say you borrow 10,000 over 5 years at an interest rate of 5%. You will pay back, or you'll have a total of 2,500 additional payment in addition to the principal of 10,000. Right. So you will pay back 12,500 over that 5-year term. If that was on, and that's on a simple interest basis. So as you can see there, 5 years, 10,000, it's 500 a year, because it's always based on that principal amount. Right. If, however...
So far, very straightforward, by the way. Thank you.
Hopefully so. But if we were to use the compounding effect, the calculation becomes slightly more complicated. But in essence, the amount that you borrow increases to 2,760. So another 260 above and beyond the amount that you would have paid on the compound, also on the simple interest calculator.
So an extra 52 a year or something.
Yes. So right. Obviously on this example it's quite small, but there's not many cars you're going to buy for 10,000 dirhams. Yeah. Or dollars or pounds. You can see if I put a zero on the end, suddenly that difference then becomes 7,620. So suddenly the difference also has gone up by
and the
a
annual
factor
was
of
then
10.
520. So and you can see as you add zeros, your average car, I don't know if there's an average car price, but 100,000 is more likely than 10 for sure.
Exactly.
Yeah, okay.
And a 5-year term is quite normal, and that's an interest of 5%.
Got you. Okay.
So that just, again, to give perhaps a more practical example, or an example with some numbers that people can actually hopefully start to visualize. Because again, when you're just sitting there, there's the bright shiny new car, you've agreed a number, you've agreed the term, suddenly, and you've even agreed the monthly amount. How that interest or that amount is reached is probably way down the list of priorities. Can I have it? Can I afford it? Yes. However,
I love watching the cogs work when you're phrasing stuff.
You know, but I want people to be aware, and actually, if they were to step back for that 2 seconds and think, hang on a minute, what are the differences? And one is the interest rate itself. You know, we walk into that dealership and they present you with their package, because again, they're probably tied to one particular bank, one particular provider.
Yeah.
But you're entitled to go to the market, go to your own bank, go to another, and just to see what terms are available. But likewise, is that ask them. They should say simple interest, but there's no harm in having that conversation with the lender that's providing the loan to you, so you understand.
Well, there's another side to this as well, isn't there? Let's take a car as an example. It's a good example.
Yes.
So many people do take car loans. Obviously we live in a car city. What often happens is in some of the bigger dealerships, assume you're buying a new car, you may have desks from certain insurance companies there. There may be certain offers. There may be a range of offers there. I wonder if lots of people look at the car they want, identify the vehicle they want, and then look at the offers, but look at the offers in terms of this is what the monthly payment will be over 5 years, rather than this is how much you'll have to pay by looking at the interest rate over 5 years. Do you see what I mean?
Very much so.
And I think more often than not, that's what happens.
Almost becomes the price of the vehicle becomes large, not irrelevant, but it's secondary, as you rightly say. Is that monthly payment affordable? And I'm sure, suggested. Coerced? Coerced is perhaps too strong, but there will be, use our man here, our person here, because it's all under one roof. There's the insurance, but you might not want there. It's convenient.
Absolutely right. No, and there's nothing wrong.
You walk in, and there's, again, nothing wrong with that. But there's also nothing wrong with you just taking that step back. That car will be there, unless it's a supercar, a one of however many. If it's a normal vehicle, there will be another one.
So take a step back.
Take a step back. Yes, you want that new car. You've identified what you want. I say using it, but whatever it may be, just have a thought. Not just because if you can save even 0.5% on that interest rate, suddenly that monthly payment reduces significantly, or the term can be reduced because you've said that actually I can afford that amount each month.
Yeah.
So both are very worthwhile outcomes just by having that pause and to look at what's available. Now, it may be that offer is the best, but you don't know until you compared as to what else is available.
Yeah, it's the old thing, isn't it, of doing your research. And you make a really good point there, that there may be a way of reducing the term of the loan. And if you could have a 3 or a 4 year loan rather than a 5 or a 6 year loan,
exactly.
That takes the pressure off.
It makes a huge difference, because again, going back to that compound effect, or even the simple interest effect, if the example was 500 dirhams a year. Well, if you've chopped a year off, you save 500 dirhams. And if it's put the zero on the end, which is probably the more realistic, you've actually saved 5,000 dirhams just by doing a bit of shopping around, a bit of investigation, having a bit of thought, and just making sure that you're getting the best deal for you.
You've given us an idea of how compound interest works there. And, obviously the more zeros, the higher the debt is, the higher the the initial payment is, the more it mounts up. But it's worth getting into. I don't know if you've got any examples of this, and it's a very hard thing to put into words. But just to look at how compound interest compounds, how it mounts up, and the speed at which it can mount up, because you can go from a relatively simple amount and all of a sudden think, hold on a minute, that it takes you by surprise, James, doesn't it?
Very much so.
Yeah.
As to how it's calculated, I mean, the key difference is the interest is, again, this is why it's the eighth wonder of the world when it's in your favour, but when it's working against you, it's a complete opposite of that, because the interest is. So if we take that example, 10,000, 5%. So next year it's 105.
Yep.
But rather than with the simple interest in the second year being 110, it's something like 111 because it's 5% of the original amount plus that first year's interest.
Yep.
And then again and again and again. So suddenly you can see that's why that, in I say, it's a very small example, it becomes 260 odd dirhams or whatever currency difference, because you're then actually increasing the amount that you owe because it's being calculated on principal and interest that's been added in the previous year.
And that interest is building every year, and it's building up.
And the examples I'm using here is a relatively small amount and a relatively low interest. I did a quick calculation just because it made me chuckle when the offer came to me. My credit card company.
Here we go.
Yeah, right, no names mentioned, but they said to me, "You've got this wonderful offer, borrow some money at 3.15% per month."
Okay, so that is immediately, that's 40% a year.
Just shy of 40% a year.
Wow.
So that's when it really starts to bite, because that's a well-known bank institution in this country, and I'm sure other companies would be offering similar amounts.
Well, I get these calls all the time. We're offering, cash up to a certain limit of your credit card, whether it's 90%, whatever it is, and you should take up this offer now. And I always think, well, is it free? And obviously, it's not.
But using the same amount, if it's 10,000 in 1 year, that's obviously 13,800. But if just simply there, because it is charged monthly, that 13,800 becomes, because that's a 38%, just to clarify that, becomes 14,500. So there's nearly 800, more than 800, nearly 900 dirhams more because it's calculated monthly. So just to add another, so that's another factor to be aware of.
So this is the interest on interest you said right at the start of this conversation. Right, okay.
So suddenly in a year, if you weren't to repay that back, and again, put a zero on the end, which is probably far more realistic amount that people would be borrowing, there's nearly 9,000 dirhams just in a year on that amount. So 9% of your principal extra.
Okay, so
so that's how, and again, I'm sure that's probably how the case that went to the court ended up growing so enormously, because as you can see there, that's 1 year. We don't know how long that had been rumbling on for, but most court cases are not a work of a minute. No. So you can see that the interest can accumulate so fast, and once it starts moving, it is that snowball effect, because it's interest on interest on interest, which is why the High Court very understandably said that it should not be the case. It should always be on the principal. But you can see how that snowball builds so quickly, because if you then, in 1 year, that's the difference, in 2 years, in 3 years, and if it's a larger amount, the court case was 700,000, so it makes the numbers that we're talking about look insignificant, but you can see how then the interest can grow so fast.
But to most people, 9,000 dirhams in additional payments that you need to make, that's painful. The other thing with this, and I'm sat listening to you, and I'm listening carefully, really trying to concentrate on what you're saying, not because I'm trying to show you any excessive respect here, but for a very simple reason, and I mean this sincerely. This is not the way my brain works. I don't think in a mathematical fashion. I don't find this stuff easy. I don't find percentages and interest rates easy. And my guess is that's an issue for lots of people. You know, we go back to the shiny new car example, and it's just, oh, I really fancy that. I deserve that. I've got the money. I can afford it. And that's fine. But understanding how you're going to repay that amount, it's a hard thing to follow, I think, is the point I'm making.
Very much so. And again, hopefully the examples I've used try to put it into a simple format that people can start to understand. Because as you absolutely hit the nail on the head, we are not typically mathematically minded. And I perhaps even say, not even myself, but because of having done the job for 25 years, being around numbers and seeing numbers, am I an accountant? No, absolutely not. But just being aware and just having that thought process, as your comment there, when you get called by your bank, your credit card company, it's not for your best interest, it's for their interest. And it's the same in this example. When that car is sitting there and they're offering you the finance deal, it's not so you can drive the car, so they can earn some money.
Yeah, absolutely. That's a really good point.
They don't care what vehicle you drive out of the showroom with, but they want, and again, they'd be actually quite upset if you paid cash, because they don't earn anything for that. If you've actually taken 5 years and saved that money and walk in there with your, well, I'm going to say checkbook, we don't do that anymore, or a pile of cash, but pay for the vehicle outright, they don't earn anything then, because
Sure.
you've actually accumulated the money. You've probably earned the interest as you've built that money, and then you've gone and bought the car.
I've done that before. Not for a great big expensive car,
No.
having sold a car and bought a much cheaper car, but I've done that. I have to say, I did feel extremely cool counting out notes. But I take your point. I understand.
But the point being, as I say, is hopefully to make people realise, as I say, they want that shiny new thing.
Yeah.
If someone's offering you credit, finance, a loan to buy it, they're doing it not to allow you to have that. That's a byproduct. But the main reason is to make some money from you.
And to be fair to financial institutions...
And there's nothing wrong with that. I've been in this industry, as I say, many years, and there's nothing wrong with that if you understand what you're entering into.
There's no reason for you to think, well, I deserve a free loan because I'm nice. I mean, that's
at all.
not the way the world works.
That's not what I'm trying to say.
No,
that
I
it
know.
should be, but it's not to get carried away with the moment and enter into an agreement that you're then stuck with for many years, that one maybe is not as affordable as you first thought, or is an interest rate that is not competitive, or a term that's not competitive.
Sure.
Because if you've done that research, you could find that, as we've mentioned, the term, the interest rate, the amount that you end up ultimately repaying back is way lower. And therefore you end up, or you can then get the next model up. Because if that's how, just to look at it as either you save money or you can actually go for the next model.
You could afford the sunroof, perhaps, or the convertible, or whatever. That's the point. I think that's very fair to say. But it's that understanding of simple interest versus compound interest and doing your research. James Thomas is here. He's an independent financial consultant. I want to talk to you, James, a little bit more about credit and credit bureaus and all the associated aspects of actually receiving a loan as well. Just kind of get some information from you.
Okay.
Personal finance here on Mira Business FM.
Mira Business FM. Mira Business FM.
It's the morning drive with me, Tim Elliott. We're talking personal finance this morning. James Thomas is with me. He is an independent financial consultant. We've been talking all things interest this morning. So simple interest versus compound interest, the differences, and it's very important to understand those differences. Oxymoronically is my word of the day. I don't think it's a word, James, but interest is very often not very interesting, unfortunately.
It's not viewed as very interesting.
It's not viewed that way, quite right.
But the reality is, while maybe not interesting, it's vital to know what it is, so you know what you may be paying for the pleasure of borrowing that amount of money.
Exactly, how to make it work in your favour.
Yes.
So just very simply to, I guess, kind of define simple interest is calculated on the principal amount. You borrow 700,000 dirhams, it's calculated on 700,000 dirhams. For example, compound interest is calculated on that principal of 700,000 dirhams, whatever the amount is, plus any accumulated interest, so potentially leading to higher amounts over time.
Yes,
much higher
amounts, because again, the key word is there, it compounds, because it's accumulating on the principal plus interest, then it's recalculated, whatever that amount is, and then it's recalculated again and again and again. So the effectively, your loan amount increases. The principal is because it's always going up every year and every recalculation. And
in some cases every month, obviously,
yes.
as well. Interesting that, actually. So if you think of it in chemical compound terms, everything that we learned at school, many of us learned at school, a compound is an amalgamation of two things, or three things, or four things, or five things, and
yep.
Hence the numbers go
yes.
up. So making it as simple as possible, perhaps too simple, but it's worth doing, I think. The thing about all of this is it's a reminder again, and this I think is almost a mantra, or seems to have been over the last sort of 3-4 weeks, talking to you, it's always best to pay the most expensive debt as soon as you can, first.
As soon as you can, absolutely. I mean, as we've said, many types of debts we've run through in previous conversations, but generally, a property, a mortgage, would be the lowest form of interest. Why? Because one, it's a longer term, because you're borrowing more, but it's also secured against that asset. So if you default, the bank's position is it will unfortunately could evict you from your property because it's no longer yours because you haven't paid for it.
Yeah,
that's always worth bearing in mind. So that's the lowest. And then we have the car loans because it is secure on the car. So again, it does mean that the interest rate is typically lower. And then personal loans, which is simply a cash amount, which will be higher because there's nothing to secure it against. And then finally, credit card debt. Because again, there's no security. It's not secured against anything. And therefore, the lender, the credit card company, because again, we sometimes forget they are lending you that money, will charge you a much higher rate of interest for the ease of having access to that loan, that amount of borrowing.
Well, I mean, everything you're talking about is effectively credit in one way or another.
Yes,
isn't it? And credit, the definition of credit is the ability of a customer, you, me, whoever, to obtain goods or services before payment based on the trust that payment will be made in the future. And trust there is the key word, isn't it?
Based on
unsecured debt like credit card debt.
Yes. I mean, if we go right back, what is money? It's a trust that piece of paper has a value to it.
Yeah.
Or that coin, or I know in this day and age we just tap things, but going back to where bartering and paying for things, we moved on from exchanging a piece of paper for a bottle of water or a pen or whatever it might be, whatever you'd grown. You had an animal, they had some fruit and vegetables, and you would make an exchange.
Yeah.
That then evolved into gold coins. That then evolved into notes. I don't know, we've involved further, but if you look at a note, is that you have the trust that the bearer will pay this amount.
Yeah.
So that's, as I say, the piece of paper itself is worthless as a piece of paper, but it's that trust, it's that credit that backs it up, that it will continue to have that value when you go and exchange it for something else in the future. So that's where the credit worthiness comes from.
Yeah. It's interesting to look at it that way because, we all like to sit and count our piles of cash, don't we? And it makes us feel good. But essentially, that cash, we are trusting in the central bank of X country that, that cash is worth what we think that cash is worth.
Yes.
Okay. So you take a loan and it's secured on the car or on the house, but if you take a personal loan or you use a credit card, it's unsecured, hence higher interest rates. How do you determine whether somebody is worth the bet, as it were? How do you determine whether somebody, is of value to a particular financial institution? We're talking credit bureaus next, aren't we?
We are, yes.
Yeah. How do they work?
How do they work?
Put that in a sentence.
Well, essentially, it's as you said, is to assess your creditworthiness.
Yeah.
Are you a good bet? A good risk?
Yeah.
What is the risk?
A risk, exactly.
What is the risk of lending you that money?
Yeah.
And they will then use a number of factors to assess whether you are a good, indifferent, or bad risk. And therefore, whether one, they will lend to you, whether they will not lend to you, or if they do lend to you, the irony is they can probably would charge you a higher interest rate because they think you're a higher risk.
I'm with
That's how often it's assessed. The lower risk you are, the less you pay for the pleasure of borrowing that money.
Sure, because there is an expectation that you will actually
Yes.
do so. Okay.
And how is it assessed? Well, there's a number of factors, and different credit bureaus will take a different view on the circumstances they're presented with, what you're looking to borrow. But it boils down to some very simple things, not dissimilar to the fact find that we would complete at the beginning of our process. But it's to look at your employment status. Are you employed? Who do you work for? If you're a multinational, you're likely to be better rated than if you work for an SME or yourself. Are you self-employed?
There's a more reliable stream of money coming in.
It's viewed a reliable stream of money coming in.
Okay.
Absolutely. So that's the assessment that they're making based upon that. How much do you earn? What is the income that you're actually receiving? How long have you worked for that company? Have you just joined them? Are you a long-termer? That again will have an impact on the assessment. Then a view of what you're already spending. What are your outgoings? And what other debt do you already have? So that will be assessed to work out what your affordability to take on further credit, further debt.
Okay.
And I'm sure there's a number of other factors, but they're the main ones that they will use.
Okay, and all of this then combines with the credit rating agency, the credit bureau, whatever it's called in whatever country you're from. That then combines to give you a score, which is a level, which is essentially the number that kind of it represents your ability to pay your loans, to meet your financial obligations.
Yes.
And that's how it's seen.
That's how it's seen. So that all that data is fed in, and a number is generated, as you rightly say, and whatever chart they use to apply that number. But yes, in essence, that number is then your number, and I should add also, going back, I think how you have maintained previous credit. Have you been a good borrower? Have you paid your credit back on time if you've had credit in the past? I remember when I first went to university, someone said to me, get a credit card. I was quite nervous because obviously you'd heard horror stories, but no, the reasoning being was that it starts you on that journey of generating a credit score. Right. You then appear on these creditworthiness assessments because you've had that credit card, you've been seen to actually use it, and you've been seen to repay on a regular basis. It starts to generate that score.
Okay, so if you've got a credit card and you're a good financial boy like me, I've learned over years to use a card, and I use it to book flights because very often there are benefits to doing that, etc. But I always pay it, and I always pay it in full before the end of the credit period, 58, 60 days, whatever that is. I just have a habit of doing that.
Very good habit.
And this is not, look at me, aren't I fantastic? This is just a thing that I do because I don't like the feeling of debt, the responsibility. I'd rather not have it. So I do it, but I use a credit card relatively sparingly. So I don't generally use it for groceries and stuff like that. If you do that, so you're being a good financial boy, how favourably is that looked upon by an agency, a bureau?
This is pure opinion, but it certainly in the past has been viewed as not as positively as actually leaving some of that debt on the credit card, because in essence you have not borrowed the money. It's viewed because if you wait, and you're then actually managing a debt, whereas if it's paid off, in effect it's looked upon, or certainly was looked upon, as almost just treating it like your bank account, as a debit card as opposed to a credit card.
Okay.
And therefore it made it more difficult to assess whether you were a good potential borrower or not.
So if you're paying the minimum balance back, because with credit cards, it's always your minimum balance is due at this point.
Yes.
So you have to do that. Otherwise, it's, other fees
So that's
will apply.
that's a very good point. If you pay the minimum, you're again, it depends again. There would be an assessment of how much you owed and how much was left on the credit card. But yes, certainly, let's say you borrowed that 10,000 and you only paid 5 and you paid 2.5 and 2.5, you've seen to manage and repay that debt, as opposed to simply paying the 10,000 in one go.
Okay, so you haven't paid the full amount, but you're meeting your financial obligation.
Yes.
Not in full, but you are managing to get some way there.
It was often viewed that you have then demonstrated an ability to manage that debt.
Okay.
Now,
okay. Even though I would contend I'm a much safer bet, because I tend to pay.
I agree.
I will pay.
And again, maybe some of the credit bureau may argue or comment against that. But that was certainly in the past how it was viewed, that because that helped your credit score, because you were actually seen to have had credit.
You're financially active as well.
You're financially active as well,
yeah,
yes.
Okay.
Now, that's when car loans and other loans, personal loans, are also more beneficial from a credit score point of view, because you then did have that debt and you have then repaid it. And you've been seen to manage the repayment of a debt with interest. Because with the repayment each month of the credit card, you never actually accumulated any interest.
I guess as well, there's an element here of what credit bureaus need to do is build up a full financial picture. And I'm playing devil's advocate here for a moment.
No, you're absolutely right. And again, I think, to interrupt, that's more now. They've become more and more sophisticated.
Right.
They are actually, as you say, they're trying to build a view, albeit on a snapshot of that day that you're applying for the loan or whatever it may be, because obviously circumstances would change. But that's often why, certainly for larger amounts, they'll ask for 3 to 6 months bank statements. So it's not that snapshot, but it is to see your outgoings, incomings, and actually to be able to see what's left at the end of the month, because that ultimately is what they're looking to try and work out, is what's left. Are you managing your incoming and outgoings efficiently, so that if they were to lend you whatever you're asking for, you would actually be able to repay it.
Okay. So essentially your credit report goes some way to providing that, the basis of that information, I guess. And that's really what credit bureaus are trying to do, is build up that picture.
They're trying to build up a picture of your situation and hopefully avoid the situation where there's a default.
Okay. So a credit report, it's quite an easy thing to get. I guess there's a fee of something like 80, I think it's 84 dirhams to get the kind of baseline report, and I think it's a little bit more than that. But the point is that none of this information is hidden. Assuming you are who you are, I think you have to use the particular app. What's the app called that we use, which has your Emirates ID in? It's now completely entered.
Yep, got that completely out of my mind.
I'll find it because I've got it on my phone. Just fill for a moment, James, and we'll get there. UAE Pass.
UAE Pass. There we
so
go.
you can access credit information through that there, so that it's accessing the right person. That's the security feature there. Why do you need a credit report apart from I want to get a loan. Are there any other uses for it? Any other necessities that you need a credit report for?
As far as I'm aware, no. I mean, because
can't
it's
think
a
of anything.
very
It's very
specific to that purpose.
Okay.
But it has, so if I may again interrupt, taking a step back, why has it been introduced? It sounds very draconian and it sounds like there's a lot of information required. But actually, it was to make sure that people could afford to borrow that money, because it was actually done to help borrowers. Because going back to the points that we made, you see that shiny new car, I want it. Well, actually, can you afford it? In the past, you would have just applied directly to either the provider that was in the dealership or to your own bank. But also it was to protect the banks, because unfortunately there were some unscrupulous people who applied multiple times to different banks, borrowed a lot of money, and then vanished.
Yeah.
And again, in this day and age, it's very much harder to do that, but it did happen in the past. So a centralized database, you can't then apply to multiple banks. You can apply, but you will not be lent to by each of those banks. And it was just a way to keep a much better control on debts.
Yeah, that would flag, obviously,
Yes.
the system, in that particular example. I'm just looking at Etihad Credit Bureau here, actually, supporting Emiratis and expats with their official credit score and report. Just celebrated 10 years since their first credit report. They've got something like, there's a lot of information in these, 31 million IBANs in their database. We'll have a unique IBAN for our bank accounts. If you're ready to know your score, you can get it through your personal credit report through UAE Pass, as we said. You can also download an app or via TAM and Dubai Now. That's available there. So it summarizes your personal information. This is what I was wondering, what else it does, what it's for. Financial obligations and bills for the past 3 years. It looks at that, as well as your last reported salary. It's data collected from banks, financial companies, telecoms, utility providers, courts, and government entities. If you want it, you can get your credit score, get this, for 10 dirhams 50, so that's 10 plus VAT, I'm guessing there. Your full credit report is actually 84 dirhams. Which includes the VAT. So that's your credit score, your credit history. So if you want to look at, I'm doing this wrong, or how great am I, you can confirm that or not for 84 dirhams. That doesn't seem unreasonable.
It doesn't. And also, again, if you're then looking or considering taking a loan, knowing that information will be very helpful potentially when you do go to apply, because you can see.
Well, it might determine whether you get the loan or not.
One, there's that, but also,
is it worth bothering?
Is it worth bothering?
Yeah.
Yeah. Or if it flags something, maybe there's a long forgotten bill or outstanding, the last payment of something that was cancelled a month early and then long forgotten about, but it's sitting there, that can be resolved and settled. And that can very much help your score. But again, going back to forewarned, forearmed, you can then, if you know your score is an attractive one, you know that if the bank or the lender is offering you a particular rate, you can say, no, I know what my score is. You should be offering me a better rate.
That's interesting. So that potentially
use it as a bargaining tool.
It could be a bargaining tool.
Yeah. Because if you know, they've tapped the information in. No. I've checked this. Here's it. Because why not? Because they, again, remember, they want to charge you as much as they possibly can. Because they are a profit center.
Yeah.
So it's a good bargaining tool.
I wanted to point out, I thought of this earlier and I didn't say it, but we should point out that Islamic finance works in a completely different way in terms of interest, which is, forbidden, I believe. It's haram in many ways. So this is very much what I suppose is kind of generically termed conventional.
This is conventional, yes.
Finance. So that's what we're really talking about today. We're not really looking at Islamic finance for this particular topic. Let's just conclude things, James, because we started off talking about compound versus simple interest and the importance of knowing, the importance of understanding. We've gone on to credit bureaus, credit scores, and everything else. But these two topics are very much interlinked.
Very much so.
aren't they? What would you say, just to finish off the conversation? We've got a few minutes to just round things up.
What I would say is it's, again, just another element of one's financial situation that if you understand what's going on, you're in a far better position because you will not be taken advantage of, or you will not put yourself in a disadvantage because you've got carried away with wanting to buy that particular item. Or, again, as I say, I'm not, with all these things, I don't want to sound like I'm preaching, so you must not do. If you want a new car, go for it. But why not make sure that you get it at the best possible deal and the best possible price? One, the price that you negotiate for the car in itself, but also the finance deal that you then subsequently take out, because you can be saving thousands of pounds
Well, you
of
could.
dirhams.
How many people would negotiate the finance deal for their car? And I think that was
I would
point
suggest
well made.
Minimal.
Yeah, I would have thought so. And again, it goes back to that thing of, there's the car and I can get it. I can
But
afford
if
it.
you've
I can
gone
do
to the
this, and
credit
excitement.
bureau, you've paid your 84 dirhams, you've got your credit score, you can see that your credit score is really good because you've been a diligent repair of any other outstandings. And again, as it mentions it, so it looks at things like your utility bills, your telecoms bills. So all of these things are recorded. So you've paid those on time. So your score is top notch. You should be getting, and you work for a good company that's paid you on time, that you've worked for a number of years. You're in a position to be able to say that the interest rate should be more competitive.
It's a good point. Yeah.
And therefore, you're borrowing, let's be honest, a car 100,000 plus, that's going to make a significant difference.
It should. And with my sensible head on, 84 dirhams for a credit report
It's money well spent.
isn't really a lot of money,
No.
is it? When you think of the amount that you're laying out. So understand the differences between simple and
Be
compound
aware,
interest.
I guess, as always. Be educated, understand what
Yeah.
you're getting into. Then there'd be no surprises, unwanted surprises during the course of the term of the loan.
We need to come up with a slogan, I think, a be aware slogan, some kind of acronym that works. So compound interest, generally more beneficial for savers.
Absolutely.
And investors. It allows for more larger growth.
That's where you
over
want
time.
compounding.
That is. Simple interest, better for borrowers.
Better for borrowers.
Okay, results in lower total interest payments over time. I think we got there, James.
I certainly hope so.
I hope it wasn't too technical in places, but James Thomas is an independent financial consultant, personal finance, Thursday morning, Mira Business FM, talking about interest, hopefully in a reasonably interesting fashion. Well, the jury's out there, I think, on that. James, lovely to see you.
And you, thank
Thank you for coming in. This is Mira Business FM. It's the morning drive. We are available at mirabusiness.fm. You can find us there on the website. You can find us on YouTube. You can find us on Instagram. You can find us on LinkedIn. You know the score with that. If you want to get in touch with us, info@mira.fm, and the WhatsApp number. You don't need the number, just type in whatsapp.mira.fm and you should find us easily. As I say, this is Mira Business FM.
Mira Business FM.